still in Module 3. We are financing the enterprise. The next chapter in our module is Chapter 15, Money and the Financial System. Our learning objectives for this particular chapter is going to be a definition of money and its function and characteristics, the types of money, the role of Federal Reserve, and how it regulates or manages and regulates the American banking system. We're going to compare and contrast the differences between banks, savings and loans, credit unions, and mutual savings banks. We will distinguish among non-banking institutions, which are pension funds and mutual funds are some examples. And finally, we're going to investigate the challenges ahead for the banking industry. And the use of money, the study of money is finance. And many people, I'm going to divert for just a second, many people seem to think that accounting and finance are the same. I have to tell you they are not. Finance is the study of money, how it's made and how it is managed, how it's lost as well. Accounting is going to be the record keeping, the recording, and the interpretation of finances, of money, of businesses and their financial system. So it's definitely have some similarities, but for the most part, finance is quite different, and which is why in this module we are going to be going over not only accounting principles, but we're going to go over financing principles as well. Currency is money, and we all know what money is. It's going to be in coins and dollars. In the United States, well, it will be euros in another country, and it will be shekels in another. But for right now, we're going to be talking about the finance and currency. We're going to be really mainly discussing cash and how it is moving around from person to person and business to business. So money is going to be used to pay goods and services, and anything that we accept in exchange for cash. And except for cash, we're gonna get that currency. There was a time when we didn't actually have currency. We used, but we had a barter system. But the flow of those type of barters or exchanges were very similar to currency. And now that we have this uniform way of medium or mode of exchange, we do not want to give away gold. As we know, gold is not something that we want to move around, and it's very, very hard to move that kind of thing around, and it's very difficult to assess a value. With currency, the Federal Reserve and all the other regulators kind of determine what the dollar amount is worth, and that governs how people accept it and what they use it for. So we have paper money. The function of money, obviously, is going to be an exchange medium. It's going to be how I get services from another company. I'm obviously going to pay for it. Whether I pay for it in terms of an ACH going into their account, or using my debit card, or using my cash, physical green money and coins, the bottom line is the function of money in the general sense is going to be the means of exchange, and it's going to always be something that we will be exchanging for a good or service. Now, money has to have a value. Money has to be able to be stored so somebody can use it. It has to be something we can physically touch and give to someone else in exchange for something else. And it does have a value. The complicated issue that we will not talk about in this class is how money is valued, because although we have a face amount of $1 bill in front of us, it's not really valued at $1. It really is worth maybe 37 cents. But at the end of the day, we do understand and respect that measure. Now, and as you know, you can accept it anywhere in the United States. You can use it to divide it among various different, it can be it's divisible, meaning we have denominations of $1 bills, $5 bills, coins, etc. And we can move those monies around or those bills around in any way we need to in order to meet the obligation that is before us. Because of our nation, money is basically stable, it is durable, and it is a very difficult, in fact, very close to impossible to counterfeit. This is an example of the dollar bill, and as you can see, all of the undercoding and all of the different wording within that dollar bill makes it extremely difficult for someone to actually counterfeit it, change it, make it something else, and then use it for an exchange. And one of the things about on the dollar bill, whether it be a $100 bill or a $50 bill or a $5 or $10 bill, the bottom line is it is not to be denied. You have to accept it as a mode of exchange. What companies have to do when they see a dollar bill, they can test to see if that dollar bill is a valid dollar bill with using some kind of tools that they use. But in the end, all U.S. currency is going to be backed as a reserve note, and it is payable or used to pay debts, both public and private, which is enclosed on there on the dollar bill. Now, one of the things I like about the dollar bills is that you can see these codes here and all of this under codes here. This gentleman here is Timothy Geithner, which is the Secretary of Treasury at the time this bill was actually printed. And you'll see different serial numbers and all of that sort of thing on these bills. The Federal Reserve does control how many of these little bills go out in a day, and that is another way that they find that they control the use of money, and they control the value of money by limiting how much is in circulation. But we'll talk about that a little bit later. So we are talking about pennies and nickels and dimes and all of that, and that is going to be dealt with, I think, with the Bureau of Engraving or some other agency that they actually make pennies and coins and nickels and that kind of thing, and what it's made up of and all of that sort of thing. But the bottom line is it's part of currency, and it is used to make certain that all of our public and private debts can be met with that currency. Types of money, obviously paper, coins, and dollars, which we've seen, but also we can have our checking account, we can have our savings account, we can have other types of ways to pay bills. This is what a standard check looks like. I've talked with many students, and many of them do not use checks, but it is still good to know what a check looks like and what type of things that you will see on a check and what they mean. These are clearinghouse numbers, and this again allows the check to go to the right place or the right clearinghouse in order for it to be paid. These numbers identify a bank and various areas within a bank. It also tells you who is going to be responsible for that check and their signature and who they're paying it to and the amount. This information is quite important because the processing of check is going to be all electronic. Therefore, this information at the bottom of a check is extremely important, and it does allow the check to clear within a certain number of days. But nowadays, we're not really writing much checks. We're doing ACH transactions, which we are going to be taking a memo entry from one bank account to another bank account without having to write a check, but it serves the same purpose. Types of money also includes money market accounts, which are going to be a little bit higher interest rate, not much. Today we probably get maybe 50 or 60 basis points which is maybe a 0.5% on our money market accounts. It's really not a good source of interest. However, there's still a source of holding money and types of money, so it's okay. A CD does allow you to have a little bit more interest, but you will deal with some penalties if you take the money out. So CDs pay a much higher rate of interest than a money market account, but you are not allowed to take your money out unless you are willing to deal with a penalty. Credit card is another way that you can mean payment of private or public debts, and they're financed by a company, a bank generally, who will allow you to pay your debts with that card, and then you pay them with that with your currency plus a fee, which is called interest. And credit cards are a very complicated mode of exchange, and it does carry with it interest, and it does carry with it a risk of theft. So you have to be very careful about your credit card, making certain that you use it wisely, but also that you don't allow anyone else to use your credit card, because you can pay for services with that card. So we got a debit card, and again, a debit card, like a checking account and a savings account, allows you to directly access your money, except instead of you're using cash, you're using the card. It is not a line of credit, so that debit card is only useful if you have money in your account. And everybody knows that. Treasury checks, money orders, and cashier's checks, they are near money, they are very close to money, and they are considered cash. But nevertheless, they're not used as often, simply because people have the ability to pay for their bills and to exchange services and monies over the internet. Therefore, travelers' checks and money orders are not used as often. They are still used, yes, but they're not used as often. Many people who have checking accounts would prefer to use their debit card to handle their bills. But let's talk about the financial system. The Federal Reserve is the Fed, and it is the overseer and the watcher of our American financial system. It is an independent agency of the government. It is established to regulate the industry, making certain that people are not stealing, making certain the policy of how much money goes out, how much money is received. It regulates the banks. It manages clearinghouses, which is where your money gets taken out of your account and put into somebody else's account when you're paying your bills. but it also ensures that if there is an issue of a bank going under, that your money is protected up to a certain limit. This monetary policy, it does allow for us to, or the nation to, control the supply and demand of money. And what that does is really keeping the inflation rate controlled. And this is one of the things about this nation that is unique. We have a policy, a monetary policy that has a huge effect on inflation. We have consistently controlled inflation with this nation, where it is not the case in Israel, it's not the case in Europe, and it's not the case in other Middle Eastern countries. They cannot control inflation, and thus everything that's paid overseas is extremely expensive because of the volatility of being so huge. Whereas in America, because we have a monetary policy that's been on for many years, maybe 70 years, our fluctuations in value of our dollar and the rate of interest that's paid for debt and for income is controlled through the monetary policy. We do not experience the I guess the volatile aspects of changes in prices. This is just the nation as a whole and how we govern our money and the flow of money. Very, very unique with the United States. Now, other nations have some kind of policy in place, but ours is pretty much the most stable out there, and we rely on it. So, money transfers. How do we get money to move from one place to another? This is just a way of moving money, but it is not well supported. Again, developing countries have this, and people can't, get their money as quickly to pay for food. This is what makes our nation very, very unique. We can go from one place to the other and not have to worry about traveling and trying to find our money or trying to get our money to access it in order to pay for things that we need. But this is something that's still a problem, and it does affect nations across the globe. But there are the tools that the federal government uses to control the money. And what I mean by controlling, how to regulate it. Regulate how much goes out, how much comes back in. That is critical, because if everybody had access to millions and millions of dollars, and the value of the money would be almost nothing. So what we try to do, and what the federal government try to do, is control how much money is available out there in terms of currency. By controlling how much money goes out, it does provide a mechanism for, now could I say, controlling the rate of interest, the value of that dollar. So the federal government uses some tools to regulate the supply of money. It does buy some securities. It does sell securities. It does dictate the rate of interest. That means if it can increase the rate, they can also decrease the rate. And as you know, if you're going to decrease the rate of interest to a bank, the bank is obviously going to increase or decrease the rate to the consumers that they obviously lend money to. Reserve requirements. Banks have to have a certain amount of money in their reserve, in their bank account, in their vault at any time to pay depositors for their money. And depending on the organization and depending on the size and some other factors, they have to have a certain reserve. And the reserve balance is very different depending on the organization. So the federal government will require, if there is an issue of a money supply, they can force a bank to decrease their reserve, which means they have to make loans, or they can increase their reserve, which will require a bank to hold on to money and not make loans. And by doing that, it changes the supply of money. They also can be involved in credit controls, which means that they would provide credit at a more or less restrictive way, which will allow the flow of money to go from bank to consumer, whether it be to an individual or to a bank. The whole point of the monetary policy is to ensure the flow of money and to control the rate of interest. And they do it with these tools that we just mentioned. It is far more involved than what we will go over in this class, but you just get a general role what the Federal Reserve will do and cannot do. So it uses policy to keep money flowing. It is the economy, but it does have a protection that it does keep the money flowing. But if the money is not flowing enough, it will stimulate the flow of money. And that's how presidents have notoriously used the monetary policy to stimulate the economy. When the economy gets sluggish, when people are not spending money because they have no money, and the economy will slow down. See, the flow of money is such that when money is spent to pay me in my salary, I take that money, a portion of the money I save, and a portion of it I spend. The spending portion of the money is the flow of money into the system. I will pay for groceries. I will pay my bills for my home. I will pay for student loan debt. I will pay for other bills, and that money goes back into the organizations, which in turn pay their employees, which in turn pay taxes, pay bills, and the money flow just continues to circulate over and over and over again. But what happens then is if there's a tight credit crunch, which was in 2008, where organizations like banks and financial organizations couldn't, pay money, or they were getting less money, they put controls over how much money they would actually allow individuals to borrow. Which means if you can't borrow money, that means you can't spend money, and that means you can't pay bills, and which means there's a disruption in the flow of money from the banks to you or me to vendors or customers or creditors, in which case they don't get money, then they can't pay their employees, which can't pay, and it just goes down an evolving circle. So the flow of money and the controlling of the flow of money is very important, and that's why the monetary policy, as it is done within the United States, keeps the economy going. It keeps the economy going. It keeps people paying bills, receiving money for services, and then going back and buying things and buying and buying and selling and buying, and all of that money goes in and out and goes to different areas, and it follows this flow. So the policy tools is allow for open market operations. It allows the bank or the U.S. government to buy and sell securities. And by doing that, it increases money available to other organizations. It does require banks to keep amount of money in their deposit. That means that if they can keep their money, and they have to keep their money by law, that means that that's not money that they can actually lend, and that will slow down the availability of money. But the other side would be then is they will decrease the reserve and allow more money to be borrowed by others, and increase the flow of money into the economy. They also involve in the discount rates. These rates are going to be rates that will allow organizations, or allow the federal government will charge a fee, which they call a discount, and that fee, whether it be too high or low, will encourage or discourage borrowing. And again, that's the things that they can control, they can use to stimulate the economy. Because again, if you follow the economic principles, we are dealing with limited resources, and our role in economics is to utilize those resources in the most efficient way, and to identify how we can use those resources. So that's another way that they can control money. They can make money come out, be made available by lowering the discount, or they can restrict money going out by increasing the discount rate. And again, it's all about policy and why it's used, and how it can control the inflation rate, and as well as the flow of money. Credit controls. They have the authority to establish and enforce credit rules. Again, this is all about protecting protecting the consumer, but at the same time, it's also to ensure that organizations like banks do not break laws and cause harm by their credit rules. Discrimination could be one of the things that they can do. But the functions of the Fed also includes regulating banks, check clearing, and depository insurance. Check clearing, which means it tells you it's a national processing plan, where this is how long it takes for a check to clear. This is the maximum amount of time it would take for my check to clear my bank when it's been sent to another bank. And those rules are very tightly enforced, and they use a very complicated system. I think most things are done electronically, and this particular process is no exception. Regulating the banks is also just giving them rules, telling them how much they can spend, giving them the authority to merge if they needed to, making certain that the number of days that a check or their funds for a depositor is available. All of those things are the responsibility of the federal government. So therefore, the bank violates those rules, they can run the risk of losing their accreditation. Depository insurance, the federal government does have a insurance, which means that if the bank was to fold, which it has not folded since, I would say, the 30s, because of our monetary policy being in place. But if a bank is in trouble, and they do get in trouble, depository insurance will come in and ensure that your assets that you have entrusted to the bank is good, and that you can recover all your money. But typically, when a bank is experiencing problems, the Fed's is very much aware of it, and most people are very much aware of it. But so the bank and the Fed already know that there's a problem, and generally speaking, they will coordinate a merger that will keep that bank from going under. But now, banking institutions obviously include commercial banks, and that's going to be Bank of America or Wells Fargo. Savings and loans companies or thrifts, they are going to be mostly going to be dealing with loans for residential mortgages, but they also have been working and merging with commercial banks. So in many ways, you may not see a difference. You may not even see it. But anyway, we also have credit unions, and these are going to be owned by the depositors, and these are more members. The credit union, depending on what type of credit union it is, it might be a state credit union, which means the employees of the state are part of this one big pot of vested individuals who are part of a collective, in the case state employees, and they again may very well allow you to deposit your money into those accounts. Now, because they have a common employer or trade or religion or group, they are owners of that bank. So any earnings that bank has is always given back to the depositors, with the exceptions of reserve amounts. Savings and loans, they are going to be they're like say they're mutual savings banks. They're really a lot like a credit union, and again they are owned by the depositors. So any earnings that they have, with the exception of any reserve that they want to hold back, is given back to the depositors, either monthly or quarterly or annually, depending on the charter of that bank. The FDIC is the insurance that we talk about, and every personal account has a $250,000 insurance. And that's really in the case that the bank, if everyone were to run to the bank right now, to your personal bank account, and try to withdraw the money, obviously banks don't have that kind of money in their reserve. They don't. No bank has all the money to meet all of the depositors' requests if they were to come in one day, which is why the Federal Insurance Deposit Corporation is established to ensure that people do not lose their money. This happened way back in the 30s, I think. Was it 20s or 30s, when World War I believe, and the banks failed and people lost every dime they had. Well, the monetary policy was established to avoid that from ever happening again. Now, when we had this issue, we were not the only country facing serious depression with soup lines and all of that. We're not the only country. This was a very difficult time globally. However, the United States, with the President of the United States, they decided that this is something that's so serious that this can never happen in the history of this country. And we need to put together some strongholds to ensure that it never, ever happens again. And by fortunate grace, I think, it has never happened again. And banks that have had to fold were almost always absorbed by another stronger, more profitable bank to protect the depositors, and thus avoid the need for the FDIC to come in and pay $250,000. So bank failures do happen. They happen quite a bit, but the problem is we have some way to protect those organizations. So the commercial bank for J.C. Morgan that went under, now, we talk about how do these companies come together and how they are protected from losing money. That's the biggest reason. When a bank is in trouble, the federal government comes in and they decide which bank is going to take them over, and that avoids a collapse. And so far, this has worked. But we do have that possibility of, if there is an issue where the money is not going to be there, the Federal Reserve Insurance will cover that. Now, World Bank serious. The World Bank is not really a bank, it seems, but it does provide loans, and it does raise money in order to provide their, to provide their revenues, etc. But they do make bond sales. They do have certain projects that they use. The World Bank is more it's more like a business that's conducting financial type of transactions. Non-banking institutions, which you might be aware of, if you are employed full-time and you have a 401k plan, when your money is taken from your account, taken from your payroll check and sent to this organization to invest, it is going to a non-banking institution. They in turn take the money that you give it and they invest it in accordance with your parameters. These institutions, which are like banks, are subject to a set of rules that require that they handle money and that they protect their clients against losses. So they do have a wrap that allows them to protect their clients and ensure that their accounts of investments are income and available to people who need them when they retire. But they are non-banking institutions. A mutual fund and a brokerage firm. Brokerage firms, you can they buy and sell securities for a client. Brokerage firms can be for individuals, but they also can be for a group of individuals. And a lot of organizations, a lot of small businesses will use a brokerage firm to provide uh, investments for their employees so they can have money when they retire. Mutual funds generally are going to be handled through institutions, and institutional investors like a pension, like a 401k or like a 457 will dump money into a mutual fund and allow them to invest in diversified types of securities. Again, this is all for making certain that certain rules are in place that the individuals who are investing will have the money when they need it. Hedge funds are managed to invest. They want you to have a return on your investment. These hedge funds generally are used to offset losses that personally individuals may have. Hedge funds are high risk, but their returns are high. So hedge funds are generally used in conjunction with other funding or other types of funds, but they are most certainly a risky investment, but their return are much higher. So they are basically used to offset losses that in other investments for a more diversified portfolio. And typically these are going to be institutional or mutual funds or worked alongside or with mutual funds. And again, this is an insurance company called State Farm, and State Farm, they offer insurance for automobiles. What an insurance policy does is say that we believe that you will not lose any money if something were to happen. And based on some risk factors that are unique to you, you're not going to lose any money. But if something does happen, we are going to step in and make it right. We're going to make it whole. That's what insurance does. Insurance is monies that you pay in the event that something goes wrong, something that you can't anticipate, something that you can't fix, something that you cannot possibly pay for if it were ever to go wrong. We will step in and pay. Now, when it comes to auto insurance, we take it for granted, but most of the time, if you have an automobile accident, you can't pay for that car to be fixed if it's your mistake or if it's someone else's mistake. Most people don't have the cash or the resources to do that. So what insurance does, it protects you from an undue financial loss due to an accident in your vehicle, and they will pay. Sometimes you may have to pay a co-insurance or some type of deductible, but an insurance does protect you from a catastrophic loss. So it's an important part, and insurance is another part of a non-banking institution, and it does handle the flow of money. So they collect a tremendous amount of money from their policyholders, and those monies are held and invested and pay their bills. But at the same time, they have to comply with law in that they have to have a certain amount of money to pay for losses if everyone were to lose or to be at risk at some kind of catastrophic event, and they would have to pay out all these claims. They have to have a certain amount of money to pay those claims. So they use statistics and all types of different mathematical equations to assess what their risk is or how much money they'll have to pay out for losses, to ensure that every single depositor or every single policyholder, if they needed to have the money to pay for a loss, that they have the money to pay for the loss. So banking institutions, as well as non-banking, non-financial banking institutions, have to have a reserve, and they have to be able to make certain that whenever it happens, they have the money to pay for a credit problem or some kind of catastrophic loss, or a depositor who wants to get their money out their account. EFT is, I would say, the second most common way the money is moved across the globe, in particular in this nation. It is electronic. It is taking money out of your account and putting it into someone else's account by means of some type of electronic process. For many years, the magnetic tape was used, but now we're talking over the telephone and electronic terminal, which was with special encrypted software. But in the end of the day, when you want to pay a bill, you don't have to take money out of your account, put it into some kind of money order or check, and then physically move and walk over to another place or mail your payment. You can actually do this electronically, and the banking system is accommodating for that. That's a very, very important part of the banking process. ATM is another way where years and years ago, if I wanted to get money out of my savings account when I was in college, I would have to physically go to the bank and physically go to a teller and ask them to give me my money. Well, now I don't have to do that anymore. I think my second year in college, they sent me a ATM, ATM card, and that was the beginning in my mind of me being able to have more control over my money. No matter what state I was in, I could always get my money in any state within the United States, even outside of the contiguous states in Hawaii and Alaska. I could always get to my money using my ATM card. So that has been a revolution, and I believe that's been about 25 years now that they've been utilizing that ability for individuals to access their money. ACHs is another way, and I pay most of my bills ACH. I do not allow any bills to come out my pocket outside of it being through bank-to-bank transaction, and that's basically what it is. And this is just a process where you can move money, deposits around using electronic means. And generally, your payroll check is going to be an ACH. Online banking allows individuals like you and me to pay our bills online, and most of us pay our bills online, which is why many people do not use checks. We may use them if we have no choice or we're in a bad situation, but generally speaking, most of our bills are going to be paid electronically and online. And almost every banking institution, even non-financial banking, has that ability to do the online banking capabilities, allowing you to move monies in and out of your account through electronic processes. So computers have made their role and their mark in the banking industry, with all of the complexities of using the internet and using technology to process our financial transactions. It is probably the best way to, and the most efficient way to transact business, but with limitations of using banking, encryption, passwords, and all those types of things to protect your money. It is important to note that nothing is foolproof, but using the banking and technology is a challenging, and it is the wave of the future. We will continue to use information technology, and I do not see anything in the future that will prohibit that. We will also see, definitely, we will see increasing laws that will protect consumers and also protect the banking industry as a whole, to ensure that the integrity of banking and the trust is maintained, where people can be assured and confident that their monies will never ever be taken from them or stolen, and if it is, they have protection. So as you finish this chapter, I try not to go over 30 minutes, but as you finish the chapter, just realize that the role of money and how the U.S. Dollar is based on those characteristics, and the goals that are for the Federal Reserve. Get an idea of what the Federal Reserve does, what it doesn't do, and how it affects monies flowing through the system and the policy. So I thank you very much for your attention, and I will see you in the next one.